Okay, let's just dive right into this. Welcome to This Explainer, where we're going to take something that honestly usually looks like complete chaos, those endless red and green lines just frantically bouncing around on a trading screen, and we're going to translate all of that into a predictable, highly effective survival toolkit. Because if you've ever felt totally overwhelmed by the market, trust me, you are in exactly the right place.
Because, look, let's be honest with ourselves. We have all been there. You open up a standard Forex chart, and what do you actually see? It basically looks like a heartbeat monitor that's gone completely haywire, right? And I want you to know it is completely normal to feel like you're just staring into this void of random market noise, especially when you're a beginner and you're just trying to figure out, okay, where on earth is the price heading next?
And I really want to validate that feeling right out of the gate. Our source material today actually puts it perfectly. It says, spotting chart patterns is overwhelming. Don't worry, that's completely natural when you're just getting started. See, a lot of these online trading tutorials, they make pattern analysis look, well, super easy. But when it's just you sitting there alone with your chart, yeah, it's a completely different story. So I want you to think of this explainer as your ultimate cheat sheet. It's a curated guide to fix that exact problem and actually help you spot what the market is literally trying to tell you.
So here is our roadmap for today. First, decoding market chaos. Then, Section 2, reversals, basically market U-turns. Section 3 is continuations, or the trend pause. And finally, Section 4, avoiding the false breakout.
All right, let's jump straight into Section 1, reversals, which are also known as market U-turns.
Before we even start looking at specific shapes on a graph, we need to understand exactly what it is we're looking for, right? A reversal is, well, it's simply a chart pattern that indicates a likely change in the direction of the prevailing trend. Basically, if the price was going down, a reversal pattern tells us, hey, it's probably about to go up. If it was going up, it's about to drop. It is the market signaling a massive shift in momentum.
So, welcome to the reversal universe. There are just 6 key patterns we're going to master here. You've got the double top and double bottom, the head and shoulders along with its inverse, and then the rising and falling wedges. And honestly, that's the whole shebang. It's a really manageable list, and once you actually train your eyes to see them, they just kind of jump right off the screen at you.
Now, looking at these, it brilliantly illustrates how market psychology works the exact same way in both directions. It's just inverted. So over on the left, we've got the double bottom, which forms during a downtrend and signals a U-turn into an uptrend. On the right, the double top forms during an uptrend, signaling a reversal into a downtrend. They're just mirror images of each other. It's basically showing a point where the market tries, not once, but twice, to break through a barrier, completely fails, and just gives up.
Let's actually zoom in on that double bottom for a second. Notice those 2 bottom points testing that red support zone? But actually, the really interesting part here is that orange line right in the middle, the pullback high. The pattern isn't officially completed just because you see 2 bottoms. No, it's only confirmed when the price rises and definitively breaks above that pullback high. When it does that, that is your green light.
Next up, we have the classic head and shoulders, and of course, its inverse counterpart. These are characterized by 3 consecutive highs, or lows, but they're located at different levels. So you get 2 smaller peaks on the sides, those are the shoulders, and 1 extreme peak right in the middle, which is the head. Now, by connecting the points between these peaks, you get what's called a neckline. And let me tell you, once that neckline is broken, the prevailing trend is officially dead.
Okay, so the absolutely crucial point here is understanding the difference in market sentiment as we transition into our next act. With reversals, the prevailing trend is dying. It's completely changing direction. But with continuations, which is our next category, the prevailing trend is actually perfectly healthy. It's just taking a quick breather before pushing forward again.
Which brings us nicely to Section 2, continuations, or the trend pause.
By definition, a continuation is a chart pattern signaling a temporary pause or consolidation before the prevailing trend resumes. So, we are no longer looking for U-turns here. Now, we're looking for those temporary sideways movements that confirm the market is simply gathering its strength to continue on its original journey.
Take a look at the bullish and bearish flags side by side here. This inverse relationship shows a bullish flag happening right in the middle of a strong uptrend, and a bearish flag popping up in a strong downtrend. The signal here is crystal clear. The trend is healthy, it's just taking a pit stop.
Let's dissect the anatomy of this flag a bit. Look at that nearly vertical orange line on the left. That right there is the flagpole. It's the result of a sudden, really sharp price movement. What follows is the flag itself, that slightly sloping channel where the price consolidates. Basically, it's the market digesting that massive vertical move before breaking out and surging upward again.
Now, closely related to flags are pennants. The setup is almost identical, really. You still have that massive vertical flagpole, but notice the key difference in the consolidation phase here. Instead of a parallel channel, pennants form this narrowing triangle shape. Our source notes that this tightening range actually shows a less intensive effort by the market to reverse the trend. It's basically winding up like a spring, just getting ready to snap back into the prevailing trend.
Then we have the triangles. On the left, the ascending triangle forms when buyers are making higher lows, so they're gaining more and more control, but they keep hitting this flat horizontal resistance zone. Eventually, though, they break through. On the right, the descending triangle is the exact opposite. Sellers are making lower highs, pressing hard down against a flat support zone until the floor finally just gives out and the price plummets.
And finally, in our continuation toolkit, we have the rectangles. The bullish and bearish rectangles perfectly illustrate what a temporary sideways movement looks like when the price is just trapped. It bounces back and forth between perfectly parallel support and resistance levels. It can't break higher, it can't break lower, at least not until the consolidation finishes.
Let's zoom in on a real chart showing the bullish rectangle. See those blue circles? You can spot the exact bounce points where the price hits the resistance ceiling, gets rejected, and then hits the support floor and bounces right back up. It's a holding pattern, which usually shows up near an existing resistance level. But because it's a continuation pattern in an uptrend, we anticipate the eventual breakout is going to go right through the roof. And as you can see, that is exactly what happens on the far right. All right, section 3, we're talking false breakouts. Let's look at the absolute ultimate rule for avoiding this trap.
To explain this, let's look at our last two patterns, the rising and falling wedges. Now listen, these are technically reversal patterns, but they are notorious for tricking impatient traders. They look like they're continuing the trend, like a rising wedge pushes higher and higher into this narrowing range, but they are actually losing momentum. The reversal is coming, but if you jump the gun, the market will gladly take your money with a false breakout.
So, how on earth do we trade this safely? Well, it comes down to a really strict 3-step procedure. Step 1, spot the narrowing wedge range forming on your chart. Step 2, wait for a candlestick to firmly close outside of that trend line. And step 3, only then do you enter the trade safely.
I really want to hammer home this golden rule straight from the text regarding the rising wedge. Quote, "To avoid false breakouts, you should wait for a candle to close below the bottom trend line before entering." The absolute keyword there is close, not just poke its head below the line and pull back, but finish its time period and actually physically close below the line. Trust me, this patience, that is the difference between an amateur and a pro in technical analysis.
And honestly, that is the secret to translating chart chaos into structured opportunity. We've covered the U-turns, the trend pauses, and the golden rule of patience. So now that you have this ultimate cheat sheet mapped out in your head, I'm going to leave you with this. Are you ready to stop guessing, pull up a chart right now, and actually start reading the market's mind? Happy and profitable trading to you all.